This second chapter, chapter 12 in module 7, we are going to really expand on the statement of cash flows. Now, back in module 1, I had mentioned that I didn't really like doing the statement of cash flows way at the very beginning of the semester because so much goes into it and there's so much you've got to understand about accounting that it doesn't make a lot of sense to do it. And so kind of with that in mind, there's a whole chapter just on the statement of cash flows at the end of the book, chapter 12, that really goes into the statement of cash flows a lot deeper. I like to start off with, well, why do we even do the statement of cash flows? And you could think, well, the statement of cash flows, I understand it tells me where the cash is going, but can't I just look at the income statement and be able to tell that? And the answer is, well, the income statement gives you a good starting point, but it doesn't tell you everything by any means. And you also have to remember that in accounting, we do it based on the accrual method. And the accrual method says you record your revenue and expenses when they happen, not necessarily when cash is paid. So cash could be paid ahead of time, like for prepaid expenses, and it's not going to show up on the income statement. Or cash could be deferred for later. Say, like if you're buying advertising and you're going to put it on account, then it's going to show up like you spent money because you had advertising expense, but you really didn't. You're going to pay it off in a couple months next year. So that's what I put up here just to kind of give us a brief little visualization, is what if the company had revenues of 10,000 and then you add up all of their expenses for the year and it's 9,000, and you would say, oh, well, they have net income of 1,000. So therefore, if they brought in $10,000 and paid out $9,000, they should have $1,000 cash. But if we looked at the balance sheet, it says, no, they have $5,000 cash. Well, why is there a difference? And that's what the statement of cash flows is going to tell us. And it's going to show us where all of our cash is spent. We can see where cash could possibly be spent and where it's probably coming in the most. But there are some things on here on the income statement where cash is never spent, and the depreciation is one of them. You never have a depreciation expense and then a credit to cash when you're doing your annual depreciating of the equipment. You always credit your accumulated depreciation. So that's one of the things where, and this number 2, where I start listing some items where it's not really clear where by looking just at the income statement. And one of them is the depreciation expense. Yeah, it looks like it affects cash because it brings your net income down, but it doesn't. Another one could be wages, the wages expense. I don't have this one just necessarily listed on here, but a wage expense, you could have a credit to wages payable for at least some of it, maybe not all of it, but maybe 1,000 of it you are going to pay into the next year because it's the end of December. So I put some other things on here that some of them don't even affect the income statement at all. Like, what if you bought equipment with cash? Well, the equipment goes on the balance sheet. It's not on here anywhere, and the cash is on the balance sheet. So neither of those show up as an payment going out. So we wouldn't know that we spent 4,000 in cash unless we look back at other journal entries. But from a statement perspective, the income statement's not going to tell us that. Same kind of thing here, 2 balance sheet items. What if I sold stock and got money? Just like what we did last week or on just this last chapter. If I sold stock, that's owner's equity. It's on the balance sheet, and the cash is on the balance sheet. It doesn't show up that I got money. It's one way I got money besides just the regular revenue. The AR is going to come into play. Accounts receivable. If accounts receivable started going up, that means I didn't collect the money. I'm going to collect it later. Well, that's possibly going to affect this, or it will affect it. That means if my AR went up, I didn't get 10,000 in cash. That means maybe I got 8,000 if my AR went up to 2,000 from last year. That means 2,000 more went into account and I just haven't gotten that money yet. So I didn't get the full 10 grand. And then I I put one about the prepaid. We kind of looked about that. Purchased land on a note. Well, this one that you're going to see, this one doesn't affect the statement of cash flows at all because there's no cash being spent or received. They're both on the balance sheet. Neither of them affect the income statement. And that's going to lead us to one of my next questions here. How do I know if something even goes on the statement of cash flows? Ask yourself these two questions. Did the transaction involve net income? And then ask yourself, does the transaction involve cash? So you've got to actually physically write out the journal entry when you're given things like this. If you can't really visualize it in your head what the journal entry looks like, actually write it out. It's not a big deal. And then C, does the transaction involve net income? And what I mean by that is, does it have a revenue or an expense attached to it? Is one of the debits or credits a revenue or an expense? Because if it is, then it's going to affect net income. Then once you've asked these two questions and you have yes or no's, then you've got to have a little answer key that tells you what to do with that. So if only one of the two questions, doesn't matter which one, but if only one of them had yes as the answer, then the item goes on the statement of cash flows. If both of them had yes or neither of them had yes, then it does not go on the statement of cash flows. And I'll try to explain more of that, how these two work, as we get into a practice example here in a little bit. But we'll keep these in mind. That's why I have them highlighted in yellow, that this is how we're going to know if something goes to the statement of cash flows, by answering yes or no and then looking at our little answer key. Okay, so now we kind of get into starting to prepare the statement of cash flows. There are three things you really need. You need a comparative balance sheet, meaning you have the end of last year's numbers and you have the end of this year's numbers. So you have to have that because you got to know how your balance sheet accounts, if they're going up or down. You got to know the difference. And then you have to have this year's income statement, because you got to know what your revenues and expenses are and your net income. And then finally, any long-term assets or any long-term liabilities or any owner's equity items, you need to have some notes on them. Because if equipment goes up or down, you need to know why it went up or down. Did you buy something or sell something or both? So you have to be provided with that. Otherwise, you will not be able to do the statement of cash flows correctly without having those additional notes on why those long-term items went up or down, or the owner's equity. Okay, there are two methods to doing the statement of cash flows, the indirect and the direct. We're going to focus on the indirect method the most, and then we're going to finish up with the direct method, and you're going to see that the difference only lies in one section out of three. The other two sections are pretty well identical. So when we start off with the indirect method, it has three parts. Just like the balance sheet has three parts, has assets, liabilities, and owner's equity. This one has three parts as well. They're just called something different. They're called the operating, the investing, and the financing. With the indirect method, the one we're going to start with, this is something that you're, as you're going through and doing the problems in Connect, I would have, or just print out and copy and paste this maybe all to one page. It's pretty much all on one page now, but you could just get rid of this and have it all on one page. This is really going to help you, something I've made up. This is really going to help you, I think, with doing the statement of cash flows. Because when you, it's always going to be the same. When you're doing the operating section, you always start with your net income, because that's a good place to start. It gives you a good idea of where cash is going. It doesn't tell you everything like we just talked about. But then we start changing some things to make it where it does tell you everything where cash went. So basically what you're doing is you're taking the income statement from the accrual method and we're transitioning it to the income statement as only the cash method, meaning you only record things when cash happens, not necessarily when the event happens. Like let's say you sold some merchandise on credit Well, in accounting with the accrual, we record that as revenue, but for the cash purposes, we would not because we didn't get money yet. Okay, so when we start out with net income, the first thing there's two things we're always going to look for on the income statement, just two. And then the rest of them, we're going to go to the balance sheet, the comparative balance sheet. First thing, these two things never involve cash. Their journal entries do not involve cash, or at least they're part of it. The depreciation. Depreciation never has cash paid out. So what we're going to pretend is to pretend like the depreciation never happened. Pretend like we never made that journal entry. So we're going to, if we pretend it's not there, that's going to make your net income go up. So if, let's say we started with 10,000 and we had 6,000 of depreciation, if we pretend that that expense never happened, well, that's going to make my net income go up by that 6,000. So whatever depreciation is, we're going to add that back as cash being added back into the net income. Then we're always going to look for a gain or a loss, because gain or losses, they just tell you how, in comparative to the book value, how close were you to your selling price, in your selling price. If you have a gain, that means you sold it for above your book value. Doesn't mean you got extra money, just means you sold it for above the book value. So if you have a gain, then it's going to show that your income went up, but we want to pretend that that gain wasn't there. So we're going to take the income back down by the gain amount. Or if there's a loss makes your net income go down. If we pretend it's not there, then we just take that loss back out and our net income goes back up. So that's why I have these here as, if it's a gain, we're going to take our cash value back down, put it in parentheses, whatever that gain is. And if it's a loss, we're going to add it back in, just like what we did with depreciation. And then we're going to look at we're going to go to our balance sheet and we're going to look at all the current assets, excluding cash, because this is the statement of cash flows. And we're going to do cash at the very end. We're going to look at all the other current assets. So accounts receivable, we're going to look at prepaids, we're going to look at inventory. Those are the three big ones that we're going to be looking at for current assets. If the current asset, so like AR, think of accounts receivable. If your current asset increased, so your AR went from 4,000 to 6,000, that means you collected less money. More people owe you money. So if your AR goes up or any current asset goes up, that difference, we bring our cash down. And then just the opposite is if the current asset decreases. Let's say our accounts receivable went from 10,000 down to 7,000. If it goes from 10 down to 7, that means I collected money, most likely, unless I'm told otherwise that, oh, well, the reason it went down is because one of the person's account went in default, and we're never going to collect it. We'd have to be told that. But if we're not told anything like that, and we won't have anything like that in these problems, we assume that we collected the money. If it went from 10, somebody owing me now only 7, I collected money. And then we're going to go to our current liabilities. So we're going to skip the long-term assets. That's going to go in a different section. And we're going to go into our current liabilities. And it's going to be just the opposite. Because if our current liabilities go up, so think of like accounts payable. If I owe somebody 2,000, but now I owe them 5, that means I didn't pay the money. I expensed something perhaps, but I didn't pay it off. So it looks like I spent the money, but I really didn't. So I'm going to add that cash back because I temporarily saved the money. And then just the opposite, if my liability goes down, let's say my wage is payable, it went from 3,000 down to 1,000, that means I paid my workers. And if I paid them, I need to show that I lost money. Then what we're going to do is total up this first section. And we're going to take our net income and then plus or minus all of these that we have. And we're going to get one final number. And most likely, in almost most circumstances in our operating section, this is going to be a positive number. And it's going to say total cash provided from operating section. And I put provided in there in a special emphasis because the book is going to look at that in particular. You put provided if it's a positive number, and you put used if it's a negative number. So it'll say total cash used by the operating section. That's when it's a negative, and make sure you pay close attention to that. The investing section, it's going to look very similar, just like your current assets up here. The current assets are going to be almost identical to the investing, whereas if your amount went up, like if you purchased equipment and then you paid cash for it, well, obviously your cash is going to go down. If you sold equipment and you got cash for it, your cash is going to go up. So it's pretty self-explanatory here. We always look at all of our long-term assets, except we do not put on there accumulated depreciation, because accumulated depreciation, we already affected that up here. We don't want to put it in twice. We put it in when we did the depreciation expense for the year. And then finally, our financing activities. Financing are going to look just like our current liabilities. So therefore, if our long-term liabilities went up, we technically saved a little bit of money for the current purpose in cash. If our long-term liabilities went down, we probably paid them off. And then if we have a dividend, then obviously we paid out dividends, so we've got to show that as well. And all of these, we're going to say either net cash provided from investing or net cash used if it was a negative. And then the same for financing, net cash provided by financing or used. And then at the very end, what you total up is you go back up to that number you didn't use. You go back up to cash, because we did all the current assets except cash. And we put down our cash at the beginning of the year, the end of last year. And then we add all three sections, financing and investing and operating, and we put them here. So, and then we add the two, beginning plus our changes, our total net change. And that number better be the end of this year's cash. And if it is, then we did everything correct.